So what's going on, guys, and welcome back to the Nate Show. And in this video, I'm going to be teaching you guys how to properly day trade and make a lot of money doing it. So the two things you're going to want to look for when you're searching for stocks to day trade is volatility and liquidity. So how do you find these stocks? So you can use either stock screeners, or you can look up most volatile stocks and fish through those. That's usually what I do because I don't get good luck with screeners. So you're going to want to look through those. I like the prices between 8 and 20. So you guys may want a little bit more expensive or a little cheaper. Just make sure you're avoiding penny stocks because those are not the best to day trade. So you're going to look, I recommend that you guys look for price between 8 and 20, and then you're going to want to look for liquidity too because it doesn't, the filter doesn't work like that. So it only gives you volatile stocks, but you got to fish through the ones that are actually liquid and the ones that are consistently volatile when you're day trading them. So, how do you know? A lot of people are asking, how do you know if the stock is going to go up or down? And that's a huge question, and you can't always be right. But there is an analysis that you use when you day trade where you can actually predict where the price is going to be moving. So, it's technical analysis, right? Technical analysis. There's different patterns. There's candlestick patterns. There's different trends. So, candlestick patterns are a huge one. I'm sure a lot of day traders out there watching this video, you guys know of the candlestick patterns. If you're not already using that, I recommend using that if you're going to day trade because you're going to need these patterns. So they literally look like a candlestick because that's why they're called candlestick patterns. So there's very many candlestick patterns. I come across these two. These two are very common. This one is 3 white soldiers, and this one is 3 black crows. It's the opposite. One of them's bullish, one of them's bearish. This one here, bullish. The other one here, 3 black crows, is bearish. Now, is there a chance that these patterns may actually not work? Yeah, there is. So that's why you're going to have to look for 2 different types of confirmations. You're going to have to look for confirmation with the candlesticks, and you're also going to want to look for an increase in volume. So let's start with the confirmation. So for 3 white soldiers, the confirmation is either, it can actually, on the 4th candlestick would be the confirmation. So it actually can either go up on that candlestick or down, and either one could be confirmation. So you're actually going to want to look for the 5th candlestick. So say it goes down here, and then it starts going up again. That's the confirmation that it's going to work, that shows that it's actually going to happen. Okay, with this, it goes up and then starts going down again. That's one confirmation. Or it could be perfect and it could just start going up from there and then start going down and then keep going up. So that would also be confirmation. So it's a pretty easy pattern. Those are the 2 that I use the most. There are so many other ones, and you're also going to look for an increase in volume. So say the volume is at 2,000. If it jumps to like 4,000 and to 12,000, then to 20,000, that's a huge volume increase. So you're going to look for big volume increases. A small volume increase would be like 2,000 to maybe 2,030, 2,400. That just wouldn't be that much volume. And if the stock does not have that much volume in the first place, then maybe you shouldn't be day trading it because you want to be day trading stocks that are liquid. So these are some. There's also the Morningstar, which is bullish. There's bullish and bearish ones, of course. So Morningstar is used a lot. I use that a lot. There's Evening Star, which is the opposite. There's usually opposites to these, which is like that. Oops. So that would be the Evening Star. There's so many of these, so you want to make sure you can look up the cheat sheet for all of these, so you don't really need to memorize them. You could even be looking at them while you're trading, but make sure you are using these. So here are some patterns that aren't exactly with the candlesticks, but candlesticks can still be used. So candlesticks could be going up, and this is going to create a double top. If you're not familiar with that is, it's going to look like this. It's like an M almost. Shape of an M, and if you can't really tell what that is yet, then I'll just draw it out for you like this. It's basically like this. It can be more narrow, it can be more broad, and these two tops right here don't always have to be even. So if they aren't even, that doesn't mean that it's not going to work. And for me, this, I believe, has like a 90% accuracy. It's very accurate. Even when I don't want it to be, I still know that it's going to work. So you can look for confirmation on this too, even though it's super accurate. So confirmation obviously would be, if it keeps going down, you need to get out of the position. So how do you play this? One way to play the double top is if you just bought into the position and you want to try and get out. So you're not going to know that the double top is forming when it forms the first top, right? It can just form this first top here, just pull back a little bit and go like this. It could do that, but you look, because it goes, then it starts going up, and then it starts going down, and then you look for the confirmation, and you know. So how do you play this? You're going to want to sell when it's confirmed that it's going down. I would, you may not even need confirmation on this because it's so accurate, so you can sell even before the confirmation. So you want to sell around here. So this is going to be sell. You want to be able to cash out, so you know that it's going to go down. So the opposite of this would be the double bottom, which is bullish. And for me, I don't really think it's as accurate as the double top, actually. The double bottom looks like this. It's in the shape of a W, which is the opposite of an M. So it's going to be shaped like this. And it's going to start going down again. Then it's going to start going up, and you see the breakout point is right here. So that would be a breakout point. That would be the confirmation. Once it does that, volume increasing, you buy into the position. Or you hold. If you already bought before and you're worried about it going down, then you hold. So you either buy or hold. You don't sell. You want to make sure you're not selling because you could be getting a lot more. So, yeah, so when you see the confirmation, you see a candlestick. These are green because they're going up. That's when you would either buy in or you'd start holding. So that is how you play the double top and the double bottom. So the triple top and the triple bottom are just like the double top and the double bottom, except they have an extra top. And the triple top is bearish and the triple bottom is bullish. It's the same exact thing, except now you have a second chance to get out of the position or to wait in order to buy. So it's played basically the same. And here it actually does form a bit of support and resistance because obviously, if you draw a channel, it would be so you can use support and resistance even if you want to try and get out of the trade. Then you can place a stop loss right under. I know it's a little bit crooked, but you can place the stop loss. Stop loss would be placed right on the support. So I'm going to be showing you guys now the head and shoulders, the inverse head and shoulders, and the cup and handle. It doesn't have an inverse. The cup and handle, there's no inverse cup and handle. I've never even seen one before. So let's start off with the cup and handle. So the cup and handle, it's literally going to look like a cup and handle. So you're going to want to, it's going up, it dips down, makes a big U. It dips down again and it starts going up. Uptrend. So I'm not going to draw that with the candlesticks, but it's basically the same thing. I've never seen once before one like that or anything like that. I've never seen that. It's never used. So what you want to be using is the cup and handle. So as you can see, I already have the breakout point right here. This is how you play it. It forms the cup and handle. It breaks out. You either buy or hold. It's pretty simple. It's made a lot. It's not as common as the head and shoulders or the inverse head and shoulders, which I'm about to show you guys, but it can definitely be used for day trading. One that you wouldn't normally want to be seeing is one that's like a V. I mean, it could still work, but it's really not as strong. You really want to be seeing this one. That one's not as good. So obviously there's the head and shoulders. We're just going to be going up. It's going up, and then it goes up all the way to the top, and then it starts going down. And then here, you're going to have your breakout point right here. So this is when you're going to want to sell or wait to buy. Point is right there. That's how you would play the head and shoulders. It's bearish, so it's going up. It goes up there. So when it forms the first shoulder, you're not going to know. So it forms this, you're not going to know. When it forms this one, you actually won't still know because it could become even higher. But if it doesn't and it starts going down and then it forms that third shoulder and then you look at the confirmation and you know it's going to start going down, then you know you sell your position, or you can put a stop loss right here if you bought there. Put a stop loss there, or you can just sell. If you bought here, you may have to sell at a loss. That's okay. Selling at a loss is fine, or you can just wait to buy. The inverse head and shoulders is a bullish pattern, and it looks like this. So it's going down, it creates that bump, it goes down, and then it creates another bump, and then it starts going up from there. So obviously, the breakout point would be here. That would be the breakout point. So you're going to either want to hold your position or you're going to buy in. And then obviously the confirmation is if it starts going up. These are pretty simple patterns. They aren't candlestick patterns. They're with a lot of candlesticks, but they're still pretty easy. So obviously there are 4 main market averages. There's the NASDAQ Composite, the Dow, the Russell 2000, and the S&P 500. Now, how do you use these to your advantage? So if all of these are going up, you don't really need to look for as much confirmation. For me, when I see a stock shooting up and it's a green day, I usually buy some shares. So you're going to want to be doing that on a green day. Now, on a red day, which is the complete opposite, you have 4 going down and you have 0 of the main averages going up. Then what you're going to want to do is you're going to want to be a lot more conservative. You're going to be waiting for a lot more confirmation. You're not going to be throwing your money in when you see it shooting up because it could easily start going down. All the market averages are going down, so you really want to be conservative. If it's a mixed market, you still have to be conservative, even if it's 3-to-1. Say the Dow, the S&P, and the NASDAQ are all going up, and then the Russell's going down. I've had days like that, and my whole watch list was down. So you want to make sure that you're being conservative if it's a mixed or red day, and you can be a little bit more loose when it's a green day. Now, if you want to use a hedge, you can use the sell half method. So the sell half method works where you're betting that it could either go up or go down. So say you spot a three black crows, right? You think it's going to start going down, but you don't know for sure. I mean, there could be confirmation. Both confirmations could be working, the candlestick confirmation and the volume confirmation, and you still don't know, then you can use the sell half method. So say you have 100 shares. What you're going to want to do is you're going to sell 50 and then see what happens after that. If it keeps going down, you're going to sell 25, and then you're just going to keep having it, and eventually you can just sell all. But this can even happen with buying. So if there's a 3 white soldiers and you're not entirely sure, even with confirmation, you still want to use a hedge. You're not sure that it's going to go up. So what you can do is actually, instead of buying the dip, it's the opposite. It could still be good. I use this a lot too. You can just keep buying in. So you buy some, and you just keep buying. So this isn't the sell half method, but it's similar because you're buying more and adding to the position as it's going up. So those are 2 hedges you can be using. Now, the last thing you need to know before you start making a lot of money day trading is you want to have a lot of stocks on your watch list. If you only have like 1 or 2, then that's not enough because they could start going down. Like say the market just is going up, all the market averages are going up. Your 2 that you think will be really good to day trade may just be going down, and then you're stuck with none, and then you have to start doing research about these stocks while the market's open, and then you're missing all the good chances that you can make money. So you don't want to do that. You want to have like 7 or 8 of them. That's what I have. Now, obviously, you can take them off if they stop being volatile, they stop going up, you can take them off, but you want to have at least you can have at least like 4 or 5 on there. So you want enough to the point where some of them could be going up, some of them could be going down, and then from there you can single them out, and the ones that are going up, those are the ones you day trade. And even when they're going down, they could start going up, so you want to be watching them as well, but you want to have a lot of them so that in case all of them are going down, that's not what you want. So thank you guys for watching the video. Make sure you put a like up, subscribe, and turn on notifications and watch more of The Nate Show.